Good afternoon to all of you. For those of you that don't know me, my name's Simon James. I'm a partner here in the advisory division at HLB Mann, Judd. Today, I'm joined by Todd Gammel, a partner in our restructuring and risk team, along with our guests, Jeremy Samuel and Joe Asquith. Jeremy is the founder and managing director of Anacacia Capital. Joe is the CEO of one of Anacacia's portfolio companies, Catalyst Education. So by way of a bit of background, Anacacia manages over $600 million in committed funds, investing into small and medium-sized enterprises through both private equity and public equity funds. The Australian Investment Council, which is the industry body for private equity and venture capital, previously known as AVCAL, recently awarded them Firm of the Year, which is great news for the Anacacia team. In Anacacia's portfolio, Jeremy is the non-executive director of Duncan Technologies, and Shoreway Group is the non-executive director of Direct Couriers, and he's the former lead director of their investments in Appen, Rafferty's Garden, and Home Appliances. Joe is CEO, as I said before, of one of the portfolio companies, Catalyst Education, focuses on human-centered education through the Selmar, Practical Outcomes, and Royal College brands. So Joe leads a team of over 100 staff, helping to develop child care educators and aged care and disability professionals for Australian organisations. So welcome to you all. So to kick off, we kind of like to do poll questions. So just while we're waiting for participants to join in. So quick poll question. Do you think value expectations for private businesses have decreased, increased, or the same as 12 months ago? 67% decreased, 6% increased, 27% stay the same. Excellent. I'm sure Jeremy will talk to those numbers at some point during the poll. Right, let's get rid of that box. So without further ado, who's Anacacia Capital? Jeremy, private equity can be misunderstood. Can you introduce the type of companies that you like to invest in?
Yeah, thanks, Simon, and thanks very much to HLB for hosting today's webinar. It's great to be here with Joe and to chat a bit about private equity, because as you say, I think it is often misunderstood, and something we can do better as an industry is talk about what it means in a tangible way. You know, I think the newspapers often like to talk about very large transactions, and things like Virgin are in the news, you know, very much at the moment. But actually the vast majority of companies that are invested in by the sector are sort of businesses that are kind of here today and sort of here tomorrow. So if you think about, for those of you on the webinar at the moment, if you kind of think about in the last month, if you would have walked past a building site, if you would have if in the last 24 hours you would have looked up and looked at an electrical wire on the poles, if you in the last month would have dropped a child off at a childcare centre or visited a relative at an aged care home, if in the last month you've received a parcel from a courier that's maybe sent to your home or to your business, if in the last month you've gone to a local council area and you put money into a parking meter or paid on your phone for some parking, if you've been in a building in the last 24 hours and you've looked up at the ceiling and you've seen there's like smoke alarms or you know, some kind of fire protection, if you've walked past an infrastructure development in the last week, things like, for example, the Opera House being redeveloped, or the road or rail that's being done, or if you know a job seeker at the moment. And if you answer sort of yes to any of those questions, then you've dealt directly with an Anacacia portfolio company or one of the competitors of one of our portfolio companies. So it gives you a little bit of a sense of the fact that these businesses are often sort of here today, here tomorrow. So if you look at that slide that's up on the screen at the moment, for example, like Acacia provides product and services to utility companies and electrical product companies. So for example, if you think about a electricity pole, all the things that sit on that pole, the arresters, all the electrical equipment, is the sort of product that Acacia supplies. You know, Big River, it's a business that's got, you know, 200 mil plus of sort of revenue across 18 distribution centres in Australia and New Zealand, supplying building products into building sites. Catalyst, Joe can tell you a bit more about later, but it's a leading educator in post-secondary education for sort of childcare and aged care and other related courses. You know, Direct Couriers, is involved with sort of courier deliveries, particularly from business to business and business to government. You know, national presence across Victoria, New South Wales, Queensland, WA, South Australia, and New Zealand. You know, Duncan's got the largest footprint of parking meters and parking technology in Australia. So about 2/3 of the local councils across Australia use Duncan's parking sort of solutions. You know, Force Fire's fire safety business. Route Partnership is the infrastructure business I referred to before, that things like, for those of you in Sydney, for example, the redevelopment that's happening at the Opera House at the moment, or the Powerhouse Museum, or a lot of hospitals and schools that are being built. Route Partnership advises the government, or, you know, for those of you that are in Melbourne, they do work with people like Melbourne Airports. And Shoreway is the largest provider to the federal government of unemployment services for people on job seeker in regional areas. So sort of a long answer, but give you a little bit of a sense that gives you a flavour for our existing companies, and the businesses below that on the slide are some of our alumni companies who I'm happy to sort of touch upon later as well, but gives you a bit of a sense of the breadth of this sort of industry. But generally, these are companies that are established, profitable, leading SMEs. Make sense, Simon?
Yeah, makes sense. All right, let's talk about one of the ones below the line, because it's a good one. So I think it probably goes back to when we first met, or I don't even want to know how long ago that was ago, but Appen. Do you want to talk about some of the challenges that that business was facing when you first kind of approached the founders, and what you did with them to help them kind of find a solution?
Yeah, absolutely. So look, Appen's a wonderful business. It's now listed on the stock exchange. But if you go back to the early 1990s, Dr. Julie von Willer founded the business. She's a terrific entrepreneur, you know, not well publicized, but, you know, she built this business literally in her home on the North Shore of Sydney, in Gordon. And then her husband, Chris, who was a senior executive at Telstra as the business started to expand, retired from Telstra and came and joined her. And they set up offices in Chatswood, where today the head office still remains. Now, about 10 years after that, we were looking at businesses that could take advantage of the fact that Australia is a bit of a immigrant society. You know, if we looked at the 100 or so people that are on this webinar today, and we said, please tell us what language your grandparents speak, then I suspect we'd have, you know, well over 100 languages that would sort of come up there. So we were interested in businesses that would kind of take advantage of one of Australia's sort of unique attributes as a very multicultural society. And as part of that, we rang Julie and we said, look, you know, we've noticed Appen's doing some really exciting stuff around linguistics and IT, and you know, would you be interested in talking about, you know, us potentially joining you as a partner, or how are you thinking about sort of the growth of your business and succession planning? Now, the challenge you asked, for the challenge for them. So if you kind of go back 10 years ago, and this might sound a little bit familiar to today's situation, but we were sort of in the depths of the GFC. Appen had grown every year since they founded the business, and it had its first ever year when sales sort of dropped in that year that we sort of approached them. You know, Julie said, look, I'm not looking to sell the business. You know, both Chris, my husband, and I are very happy with the business. However, you know, Chris is now, you know, over 60. I'm not far behind. You know, we are starting to think about succession planning, and while we've got two super smart kids that we love and we think they're very talented, the children have no aspiration to run the family business. So we do, I guess, ultimately have a succession issue, and we want the business to continue to thrive and do so well. Story sort of short, we agreed general terms with the family, whereby Anacacia took a majority stake in the business. It enabled them to take a bit of money off the table, you know, feel comfortable financially, establish a philanthropic trust, and to help facilitate some of the other senior managers who weren't invested in the business to invest alongside us at the time. And from a due diligence point of view, I guess after getting comfortable, you know, is the GFC, you know, so Microsoft, for example, was a key client. So, you know, one of the questions I could have asked you before was, have you used Microsoft spell check in the last week? And if you just said yes, I'd say, well, you know, you've touched, you know, one of the sort of portfolio companies. So Microsoft was a pretty significant client in those days. And you know, for the first year in a very long time, Microsoft Office was not, they didn't produce a new version that year. They deferred it because they were concerned about the economic times. So one of the things from a due diligence point of view we had to get comfortable with was, well, is that the end of Microsoft, or is Microsoft going to come back the following year and the next year? Now, obviously with hindsight, it seems almost like a silly question, right? Because Microsoft's obviously gone from strength to strength. But when you're in an economic crisis and things are feeling tough, you do have to look at those issues. Anyway, ultimately, we obviously felt very comfortable with that, and we felt very comfortable with the people. Chris and Julie Von were, terrific people. And, ultimately we invested in the company. We helped them take risk in a way that I think they probably wouldn't have done by themselves. I think Chris and Julie would have said, when all their family wealth was in that one business, they'd never made an acquisition, but for example, they'd only ever done things organically. They had no staff based overseas, even though a lot of their clients were based overseas. So in the next 5 years while we were private, together we invested in the business, we hired new staff, we made a couple of quite transformational acquisitions, particularly offshore in the US, which is where their sort of client base was. And then after about 6 years, we listed the company on the ASX, and rolling the clock forward to now, our private equity fund then sold out of its holding over time. I stepped off the board together with one of my other colleagues that was on the board while it was sort of private. And today our wattle fund, Simon mentioned before, we have a public equity fund that we can maybe chat about later, but that continues to be a small investor in Appen. But now we're very much a small investor. The family still own, I think it's 8 or 9% of the company, and it's now a sort of $3 billion market cap. The value of the shares for those who bought shares from us in the IPO, the value of those shares are up more than 50-fold from sort of 4 or 5 years ago. So, phenomenally successful for the public investors that bought shares from us and from their family. Very terrific for the family who can now spend much more time with their kids and grandkids, but still also, Chris is still the chairman of the company, non-executive chair. Julie, we couldn't twist her arm to stay on the board when we listed, so she's more in the background, but has built a phenomenal sort of platform, and the company today services 8 out of the world's 10 largest technology companies, and is doing a really interesting, phenomenal job. And the earnings they just released recently to the market, and they produced more than $100 million of EBITDA a year. So unusually for many tech companies, not only is this an Aussie company kind of doing well on the world stage, but it's also doing it profitably in a way that's sort of valuable for sort of shareholders and whatnot. And so Appen's been a terrific story. And look, if all our businesses were as good as that, or even half as good, or even as 10th as good as that, then I think everybody would be really happy. It's a great sort of case study that does demonstrate when you're dealing with succession issues or growth challenges or working capital needs, how a firm like Anacacia, I guess, can sort of help partner with the management team and really, sort of assist them to sort of grow.
Yeah, it's a really good example of, I remember having the conversations when we were doing due diligence all those years ago. It's like the value of the business that they were considering as you were investing in, and they were trying to work out how much the remaining shareholding would be worth. But with the level of investment and taking on that additional risk and doing all the things you talked about, the residual shareholding was worth X times because of the value that came through the business over the preceding period. Is that right? Massively.
Yeah, absolutely. I mean, I think during the last, it's just been announced, anytime a director sells shares, obviously that gets announced to the market. So I think during the week it was announced that Von Willers sold about a 2% holding of their shares, and they got more for that 2% than they did for 100% of the value. At the time we listed, let alone the value at the time that we actually invested when it was sort of private. So we remain very good friends with them today, and they absolutely deserve it, and as does the management team that invested alongside us, and they've helped a lot of people in a client sense, but also staff sense and a shareholder sense, and it's a great story where so far it's worked well for everybody.
So I'll ask a question then. So not all of them can be like Appen, and not all of them are in a growth market like that where you can develop and take margin very quickly. So what sort of criteria do you look for in companies and other companies that you invest in? You've obviously got a diverse sort of approach here in your current list, but what are you actually looking for?
No, it's a great question, Todd. And look, it's very much by design, not by accident, that we're investing across a range of industries. So we're trying to invest in leading small, medium-sized companies that are not competing with each other. And if we are looking at a business in the same sector, then we'll typically support our platform company that we've invested and help them to acquire or merge with someone else in that sector. And there's really kind of, I don't know, there's kind of three broad things we look at, which is around the people, the opportunity, and sort of the price and the structure. So let me kind of break that up through the 6 points you see on the slide that you can see in front of you there. So from an Anacacia perspective, we're looking at businesses that have strong cash flow. So, you know, a business like Appen was always profitable since they first started the business, as was, you know, Big River or Catalyst or Direct Couriers or Duncan or, you know, businesses like Yumi's and Rafferty's and NW Group and others that are there. You know, that doesn't mean there's anything wrong with businesses that are not profitable or that are, you know, much larger, but I think our expertise, our passion is really working with those sort of profitable, small, medium-sized businesses. So for us, it's not really startups. It's not trying to work out, is Westpac better than Commonwealth Bank? It's about that small end of the market. For us, it's about local businesses. The second point there, it's about businesses where we think, gee, this is something that's on the ground. We can, so, you know, we'll hear from Jo in a minute, who's one of our star CEOs. And it's great that when she's got an issue or a challenge, you know, we can go see her, spend time with her. We're on the same time zone. We can see each other, you know, quite easily and sort of, you know, chat through, you know, the opportunities and the challenges and whatnot. You know, so for us, we're not investing in businesses that are based offshore. Even though companies like Appen, 99% of its revenue was is sort of offshore, but the core management team was kind of locally sort of based. And the third thing is really important, kind of ready for change. You know, not every business is right for an investment, obviously. So we're looking for businesses that typically have either a succession issue. So, you know, maybe there's some owners who are thinking about retiring or starting to step back, and that could be people that, you know, it could be someone like Chris and Julie who are at an age when they're you know, looking at succession planning. But there can also be, you know, HLB do a great job looking after one of our other investees, Forcefire, for example. And, you know, the two founders of that business, you know, they're not retirement age, but they were ready to make sure they put in place a succession plan that the business, in a shareholder sense, even though they want to stay actively involved, and you know, Paul Ricchetti is very involved with the business, and one of the other founders sort of stepped it back into a non-executive role, but they wanted a partner that could help them kind of manage the long-term succession and make sure they've got the right management team in place in the right sort of roles. You know, growth is almost always on everybody's agenda, and making sure they've got the right sort of platform and shareholder base and balance sheet to sort of do that. And often it's on a path towards a full sale or an IPO. So if somebody wants to sell out 100%, maximize their value today, and they think, gee, I don't really want to have anything to do with the business going forward, it's probably not the best option to go with Anacacia, unless we've got an existing management team or somebody else that can sort of come in and get involved with the business. So normally it's someone who says, look, I want to work towards a sale in 3, 4, 5 years time. However, gee, if I could sort of sell half now, you know, diversify my wealth, bring in the right partner, and then build the business up such that the end value, like the example we just spoke about, that kind of makes most sort of sense. Ready for change. You know, confidential, we find, you know, family businesses and private businesses, this is really important. You know, they absolutely want a fair price and a fair transaction, but they don't want everybody reading about it in the newspaper. And I think that's almost sort of without exception. We find people say, look, I don't want to run a broad process. This isn't like for me running a sale at my house, and that's embarrassing enough when people sort of turn up and, you know, to sort of an auction, and, you know, I want to look after the staff. I want a fair value, but I want to kind of go find a partner and then kind of try to make that kind of work through the due diligence process. So that's important for us as well, that kind of confidential sort of nature of the exact sort of terms that are involved. You know, management team is obviously really important to have great quality managers, and that can be a mixture, and we can maybe touch upon this in some of the Q&A later, but that could either be supporting the existing management team, which we're always delighted to do, and there are plenty of examples where with you know, Direct Couriers we've just invested in, you know, none of the senior management team has changed at all. You know, we've continued to back them. They're a great management team. They're engaged. They want to stay involved. You know, the example I gave of Appen, again, great management team, but they were starting to reach retirement age. So Chris really wanted us to help them find a new CEO. So we help them hire a new chief executive into the business as part of that process when they step back to being non-executives. You know, and the final thing is just opportunities where we think, and more importantly, the founders and the other shareholders think that we can add some strategic insight, and that our capital, both intellectual capital and financial capital, will help to build long-term value in the business. So they're kind of the 6 key things we kind of look at from a investment criteria, or kind of, put in summary, sort of, working with great people in sort of a fair price and structure where there's a, an opportunity that makes sense for everyone.
So really giving the business and the owners a bit of empowerment to go and do the things that they need help with, that they can't get across by themselves, so that they have support through that.
Yep, absolutely. And getting that right sort of alignment.
And going back to management, because there's a lot of management guys on this webinar, and also a few accountants and whatever else. Retaining the CEO, I mean, I assume as part of your DD, you go through and you have a solid look at those guys, and also have a very clean discussion with the founders about what their role is going to be and how it's going to all work as part of that process, so that there is no surprises. And also then your view about whether you need to strengthen the management team or get a new CEO to drive the next process. Is that part of what you bring to the table?
Yeah, Todd, look, it's a good question. And I think each case can be different. So maybe let me try to illustrate it with a couple of examples. And I always like food. Like, I love food. Probably most people here like food. I don't know. But let me maybe use a couple of the food examples, because they're quite sort of tangible and you're able to sort of relate to. So, we've invested in 2 of the businesses we saw on the slide earlier. One was Rafferty's Garden, which is a baby food business we previously invested with. And the other was Yumi's Quality Foods, which is a food business involved with dips and the like. And let me start with Yumi's as an example. So Yumi's a Melbourne-based business started by 2 terrific brothers, Michael and Benjamin, whose nickname is Yumi. That's the name of the sort of product. When we were starting to look at businesses which had branded food businesses where we thought we could add value and we thought had a good competitive advantage, we came across Yumi's and we rang them and we went to see Michael and his brother Yumi. And cutting a long story short, we agreed a deal indicatively to acquire a majority of the business, and subject to doing sort of due diligence. And this question came up where Michael sort of said, look, how do you feel about me still being the CEO? And I said, well, why do you ask that? And he said, look, I love what I'm doing. I love this business. I'm very passionate about it. It's really the only, or it's the major job I've had during my career. But I appreciate you guys are giving us a very generous check, and that's going to help our family sort of financially. But more importantly, you're going to help us to get the business to the next level and ultimately, for some kind of sort of exit. And I was the right guy to be running this business when it was just my brother and I out the back of a fish and chip shop. But, we now employ over 100 people and maybe I'm not the right guy anymore. I'd like to still be involved in the business, but if you guys think I'm not the right guy, I'm open to that feedback. So we sort of said, look, absolutely appreciate your maturity and your humility. Look, our sort of hypothesis going into this is if you're passionate about it and you want to stay involved with the CEO, we want you to be there. But look, let's go through the due diligence process and then let's have that conversation as we learn more about the business and the customers and the staff and the suppliers. And as we got to learn more about the business and got to know Michael better, we came back to Michael and we said, look, you remember you raised that issue with us about the CEO. We've done all our work and we've got a very strong view that we would love you to stay as a CEO if you're still comfortable in that role. Because yes, you were the right guy when it was just you and your brother at the back of the fish and chip shop, but you're also the right guy when there were 50 people in the warehouse. You're still the right guy when there's 100 people. And by the way, now 5 years later, he's still the right guy running the business when it's, it's increased materially from that as well. So even though he'd taken quite a lot of money as part of the process, I guess, he still was a significant equity holder. He had a passion for the business. He had the skills and the attributes and was open to feedback and change and wanting to have the support of a couple of us that went on the board as non-executive directors.
And did you change his role slightly? Did you take a couple of responsibilities off him just to give him a bit more time to focus on the things you wanted him to?
I think what I'd sort of say is, I guess we spoke to him about what he thinks would make him more effective as a CEO. And one of the things, for example, in that business was he said, gee, when we kind of looked about exactly what takes up his time, he spent a lot of time doing strategic financial stuff. And we kind of both came to the conclusion very quickly that he would benefit from having a chief financial officer in the business. So we didn't get rid of anybody. The same accounting team stayed in place, but we actually hired somebody new into the business that came into the role of CFO. And Michael, I think, would have said at the beginning, look, I don't know if I need this, but I'll do it out of respect for my relationship with Anacacia and you, Jeremy. And within 3 months, Mike was, I don't know how I ran a business without CFO. This is just fantastic. And I think I don't need to tell you, Todd and Simon, the value of a good accountant within a business, and you guys are obviously expert at that. And we see that often within our businesses. Now, just to sort of contrast that a little bit with Rafferty's Garden and why each business can be a bit different. So, so in the case of Yumi's, we grew that business together successfully with Michael. He did a phenomenal job. Ultimately, his aspiration was to have a full exit, and we did that a little over a year ago. We sold the business to Associated British Foods, which is George Weston, which is they own Tip Top Bread and a few other things. It was a fantastic result for the family, and again the management team that also joined us on the journey as invested, and great for the consumers who continue to get that product not just now in Australia, but much more globally, and the new owners who I spoke to recently, the CEO of the local CEO of George Weston, who continues to be extremely happy with the acquisition as well, and extremely happy with Michael continuing to run that business actually. Rafferty's Garden, which was another, good investment for us, but had a sort of a bit of a different management discussion. The founder this is a baby food business. For those of you that have fed a baby recently, you'd know the product. It's the pouch sort of baby food, what they call wet baby food, which is like fruit and vegetables, etc. And when we were looking at that sector, and we first approached the founder of that business, who together with some family and friends owned the company. He had done a phenomenal job growing the business to where it was. It was doing about $20 million of sales. It had taken on a market leader in Heinz in a category which had very little innovation literally for generations. Like most of us on this webinar, would have been probably fed Heinz stuff in a jar or a tin, and as would, some of us would have fed our oldest. And in my case, I fed my oldest kids that sort of food as well, and by the time my youngest was born, Rafferty's had revolutionized really that market. But when we spoke to the founder and we said, what do you really love about your job and what do you really enjoy doing? It was very clear his aspiration was not to be the CEO. So what he loved doing was mixing, fruit and vegetables and doing the innovative sort of process and being a brand ambassador. And so together with him, we helped him to sort of hire a chief executive, a guy called Michael Tinkler, and Michael came out of Unilever and Goodman Fielder, who was very used to sort of companies which had got to that size and scale and had aspirations to sort of grow larger. The founder still did a phenomenally important role, but he didn't. But then we had a CEO who spent the time with the major retailers, with the customers, with the suppliers, with the shareholders, with the board directors. And he loved doing that. The CEO and the founder loved doing what he was involved with doing. The founder continued to be involved in the board and played an important role. And ultimately, again, that was, we grew that business to 40% share of baby food in Australia. Today, if you walk into a supermarket, the jars and tins are almost completely gone. So even the major competitor we had at the time completely changed their business model in response to what Rafferty's did in the market.
But again, focusing that passion where it can add value rather than being distracted by all the other things that you need to do when you don't have that support.
Exactly, and I think the other thing is, so in that business we also helped them hire a CFO and some other hires in both businesses. And I think what both those sets of founders would say, and in fact I think probably anybody that work with us, is that when you have Anacacia on the register, it often makes it a lot easier to hire people. And it can be very tough, as I need to tell everybody on this webinar, but if you're a family business and it's a bit unclear what the succession planning is, and you're out in the suburbs, it's not always that easy to hire top talent into your senior management team. But sometimes if you can actually say to people, look, yes, you can come for a salary and you can come for the passion, but there's an opportunity to invest some equity in here as well. And you've got a pretty rational investor in Anacacia who's, no private equity firm's got a better track record. They're not perfect by any means, but they've got a great track record and they're going to be focused on helping us to grow the business. Then we find that often helps people to kind of upgrade the talent within the business. And normally that's not even replacing people, it's normally just adding to the people if you're doing a good job sort of growing the company and growing the business, but kind of helping with that sort of changes and getting, as you said, Todd, the founders to kind of focus really on what are they really passionate about and enable them to get some, as part of an Anacacia investment, particularly if we're kind of buying some existing shares, there's a chance for them to diversify their wealth a little bit and then really feel more comfortable, no personal guarantees, and get the kind of, pay all the mortgages down and whatnot, and kind of be set up, but then really have a platform to really take the business to the next level. And if we're doing our job right, we're helping to invest in those businesses for the long term. And while we may only be there for 3, 4, 5 years, we'll always sell that business successfully in that period if we've helped set it up for a much longer period on that. Because I've never met a buyer that's buying a business, and they're always very smart. They're always looking at what's that long-term shareholder value growth. So having the best possible people, having the Joes of the world that are kind of on your management team, that's what you kind of want. And we've been really fortunate to do a combination of backing the existing team that's there, but also when people are looking at stepping back or retiring or just changing their roles, just doing something a bit different, then actually helping them to sort of complement that.
That seems like a very good segue to bring in Joe. No pressure. And if we kind of look at the next slide, there's a bunch of quotes from Anacacia's portfolio company CEOs and founders when they were kind of interviewed about their Anacacia experience. So, Joe, you joined the team to strengthen management in Catalyst. What benefits have you found from working with Anacacia?
Great. Look, thank you, Simon, and thank you so much for inviting me here today. Really pleased to be sharing my experience. So I joined in October last year, and coming from working in universities for nearly 30 years in government sector, it's been very interesting transition for me. So I might talk about pre and post COVID, because that's, since I joined in October, that's something that's really significant that has happened during my 7 months with Anacacia. And I think it's been a fantastic way of testing out some of the attributes of that organisation. So look, first of all, I'd say is one of the benefits for me as CEO is to be part of that broader network. And as I say, when I talk about, what's happened during COVID, that will become really evident. Also for me, that opportunity to invest, having worked for government before, you never had that opportunity, but now it's an opportunity to invest. I'm incredibly passionate about education. That's my DNA. And to actually put yourself behind what you believe in, I think is a huge benefit. So, one of the other benefits is my building my own management team. So when I came in, I had some very specific requirements to build a strong management team within Catalyst Education. I have a board that I consult with things like that, and also Anacacia. So one of the real benefits I had in February was to actually go along to Anacacia and join in one of their regular fireside chats. Wasn't too sure what that was going to be, but Jeremy invited for me to speak to that. And what it did for me was it enabled me, we work in the vocational education sector, it enabled me to talk to people, experts, and people who had a lot of experience in other sectors, not education, to provide me with a bit of a sounding board, if you like, of what were some of the challenges being in vocational education at the moment in Australia, and draw on their expertise as to, what they saw as opportunities when I shared those challenges in the vet sector, what investments there might be, areas of building the organisation. And so that was a real amazing benefit for me that I wouldn't have got if I hadn't been part of a consortium, under the Anacacia umbrella. So you could test those opportunities. The other is, as you can see, I think you've got the slide in front of you, what other SMEs say about Anacacia. And the one word that comes out over and over again is partnership. And it's that partnership of the corporate knowledge that Anacacia brings and the industry experience. So while I bring the industry experience to the table, Anacacia really brings that corporate knowledge. And Jeremy just spoke about strategic insight. And I think that has been, again, a really strong driver for me, that I can bring the expertise from the education sector, but that strategic insight with Anacacia and also their investors that they brought to the table was really beneficial. And we could talk about funding opportunities, potential acquisitions, branching into other sectors. So that was kind of the I guess the pre-COVID world, and there's obvious back office benefits of, you know, group procurement and things like that. So I think maybe I'm preempting your next question, Simon, but you know, obviously we've all been hugely impacted on a global sense when COVID arrived. I can't think of any other way. One of the very speedy initiatives that Anacacia took was to develop a couple of think tanks, and they brought all of their CEOs together, and they also brought another group of all the CFOs together. And Catalyst Education benefited considerably for pooling all of that information and resources so that we could stay well ahead of things like employment law, the access to government cash stimulus and tax deferrals, the whole JobKeeper eligibility, and also just generally supporting the welfare of our staff and our learners and partners. I had about 48 hours to relocate 48 staff across 3 states, Victoria, Queensland and New South Wales. And the benefit of having the expertise that Anacacia either had within their portfolio, or they sought, for example, with the employment law, they brought somebody in to speak to us. I could concentrate on running the business. And when something like COVID comes and impacts the business as much as it did to Catalyst Education, that was a huge benefit, because obviously your day job doesn't stop. And I think this was particularly critical when the public information, particularly in around kind of March, April time, was somewhat contradictory between federal and state. I don't know how it's impacted other people who are listening into this webinar, but some of it was quite confusing, and the advice wasn't always aligned. So it helped us navigate through that. I believe that I brought some expertise from Catalyst Education that the other CEOs could benefit from, and I certainly benefited from the expertise that they brought. So, you know, that ability to pool our resources, and I guess without being too trite, it was, we were really living that ethos of we're in this together, and we met on a weekly basis. We're now still meeting on a monthly basis to discuss, and I think we'll probably be moving to the post-COVID world as to, you know, what learnings we can take into the future, and also what we've learned from this. So just tracking back to being part of that broader network was a huge, valuable exercise for me during what we've been going through the last few months. And I think that in times of, you know, favourable conditions, you can talk about how great you're doing and those kinds of things. But it's really in times of adversity or crisis where you really do test how, you know, your private equity firm or your owners or your board really pull together and support an organisation through that, because it wouldn't have taken a few very poor decisions to really fall off the, you know, perch as far as continuing with being able to deliver the learning courses and programs that we were delivering, which no longer we could deliver in situ because we couldn't go there.
No, it is fascinating. I like the way you kind of call them fireside chats. I think they're a little bit more than fireside chats, but there's definitely a lot of value in it, because, you know, the role of a CEO or business owner is fairly lonely, and you do need that sounding board of people to bounce things off, and to, I suppose, have that environment where you're not really competing against each other and there's a kind of common ownership makes a lot of sense. Oh, very good.
And some of those things are on the next slide, where the things that you bring to the actual structure that adds the value and brings through the things like that you've been talking about, like COVID, having that ability to be able to talk to a lot of people and bring a lot of experts obviously gives you a lot of comfort compared to a lot of other businesses similar sizes who have to actually go and find that without any real confidence that they're getting the right people or the right sort of support. So that's one of the things you get with people who do this on a daily basis, I suspect.
Absolutely. And I think, you know, although we had that formalized think tank, if you like, the spin-off of that is, you know, 2 or 3 of the CEOs that we spoke to, I formed a relationship with those about some very specific nuances in our businesses that we realized we could share information and expertise as far as that goes. And I think that in a normal working situation as a CEO, as you say, it can be a lonely place. And you would often see maybe other CEOs as perhaps being in a competitive space, even if they're in a different sector, whereas perhaps it also helped by bringing a crisis, bringing us together somewhat. But it's enabled me, and I think many of the other CEOs, to develop some synergies with one another that will outlive, COVID or anything that's going on at the moment. So those opportunities, are very new to me, and they've been hugely, hugely beneficial.
Yeah, being able to lean on a network and be able to do with these things and get somebody else to help manage all these things takes a lot off your workload, and I assume lets you sleep a bit better at night, which improves performance and all of those sort of things.
Yeah.
Because there's a lot of things here which to be able to deal with while you're trying to operate a business in unusual circumstances and looking at debt things and looking at structuring and whatever else, there was only a certain number of hours in a day that you can get done.
Absolutely. And even just going back to the information that was coming out, the federal and state government information that was coming out quite quickly, and it was generally positive. We could take advantage of things like JobKeeper, but understanding our eligibility and understanding whether we could apply for tax deferral, stimulus packages and things like that, I would really question an organisation that was our size and a similar organisation that was on their own, that they would have been able to have navigated through that in those early stages as well as we managed to, because we were on the front foot with all of those things, got things in place. We incredibly fortunately haven't had to stand anybody down, but that I think would not have been the case if we hadn't, particularly myself, if I hadn't been able to draw on collective expertise and have somebody, come in and talk about employment law. Because if I had gone and engaged somebody to talk about employment law, that would have come off my bottom line. So, that ability to, to pool, as I say, resources, because it applied to all of us. We were all in a very, very similar situation, albeit in different stages or perhaps to different extents. So yeah, that was hugely beneficial. And also, to be honest, just to feel like you're not the only one going through those things. I mean, you're not, because it's, this was a global impact. So there's no way, Jo was sitting there having a problem on her own. But to be able to just test something out and go, is this your understanding of JobKeeper? Or am I eligible for this? Because it just seems like, I'm getting different information over here. So yeah, really, really beneficial.
Having spent 40 hours on JobKeeper webinars, I understand exactly where you're coming from.
Todd and I were on 3 a week, weren't we, Todd?
Yeah, and Treasury came out with one statement and the ATO would come out with another statement, and everybody was fighting each other over how that all worked. I understand totally. At least now it's calmed down. But I think the difference for a lot of the clients that I see that have either gone through or are looking at PE as an option is that corporate governance improvement you get, that responsibility that needs to be taken, because a lot of that is unpacked and is necessary when you have an independent party come through and looking at it. And I assume as coming in as a CEO, that's probably the bits of it that you have to build up in the business that might not have been there, or tinker with as it goes forward to align with what you need, what an Acacia wants, and then what the expectations are of the community, particularly in things like what you do in education, which has not been one of the greatest areas previously. There have obviously been some people who've done it wrong, and now to be able to stand up and put your hand up and say, well, we do it the right way, is a big selling point for you.
Yeah, absolutely. And look, I've always been part of a network. I've been in education for about 30 years, but it's always been with other education experts. And I think you tend to begin a bit of groupthink when you're always drawing on experts, but within the same sector. And,
sounds like tax accountants.
Oh, maybe. I don't. I've never been invited to one of your fireside chats. But I think and I underestimated, I didn't quite appreciate how much people, I've been talking to CEOs of construction organisations and courier services, And at first glance, or if I saw their portfolio on a piece of paper, or I looked at their website, I'd think, well, they maybe not much to offer. We deliver training packages. We're very different. We're all people-centered. We've got no equity in things. It's all in kind of futuristic delivery of education. But in fact, that was exactly what I needed to look at opportunities out there through the lens of somebody who's outside of the sector. Because I think anybody on this webinar would know that if education just keeps going down the tunnel vision of the way it's going at the moment, particularly higher education, it's going to be a very, very dismal outcome for them. So I've really enjoyed that injection of completely left field ideas. And Anacacia will often, and particularly Jeremy and his team, will come with ideas and thoughts that are really outside of the box. So, that challenges me as a CEO, and I like that. I want to be challenged, and I want to see how I can grow and develop an organization, like the ones that Jeremy's been talking about prior. So that it's an organisation, and we've got 3 RTOs, registered training organisations, that are here for the long haul. We're the biggest deliverer of early childhood education in Victoria, and that's something we're really proud of, but we want to expand out beyond that. And I really need the input from the kind of industry, the corporate expertise that Anacacia brings, because I'm very well aware of what's outside of my own expertise. So complementing with the partnership that we've got with Anacacia is working really well.
Yeah. So having those sort of why not conversations
Yes.
that haven't, because you're not limited to your thinking inside the industry, it's expanding those sort of things.
Absolutely.
Yeah.
Yeah.
Thanks, Joe. Yeah, I think the bit that I get most excited about private equity, it kind of gives the founders a new lease of life. They kind of, when they've got somebody alongside them to bear some of the risk, they can actually do the things that they should have been doing and putting off because, the business is going all right and making good money and it's not broken, but actually doing what they should really be doing and driving it hard. So that's good. So just before we get to questions, I want to go to the next slide and just talk about this because it's kind of relevant because it was in the news yesterday, Jeremy. You alluded to it before, but the wattle fund, you guys at Anacacia are a little bit different than most PE funds that you do actually have a public fund. So do you want to give a quick 2 minutes on the wattle fund?
Simon, no problem. Thank you. So look, what the wattle fund focuses on is exactly the same type of companies that we focus on through our private equity fund, but in terms of the industry and the type of business, size of business. But the fundamental difference is these companies are listed businesses where we're typically a much smaller sort of shareholder. So the slide that Simon's just brought up on the screen there shows you the distribution of companies on the Australian Stock Exchange by market cap. So to give you a little bit of a sense, when you hear on the nightly news, what's kind of happened with the ASX 50 or the ASX 100 or ASX 300 or the All Ordinaries, that's typically the far right-hand side there that you can see. So there's about 259 companies that have a market capitalization greater than 750 million. So a lot of the large corporates, that's not really our focus. We're not trying to work out whether or not BHP is a better investment than Rio Tinto or Westpac's better than Commonwealth Bank. At the other end of the market, in Australia, we have a lot of very small micro equity type companies that are listed. So we've got 781 companies with a market capitalization of less than 20 million. Now, they all need good accountants like Simon and Todd, because when you're listed, there's a whole lot of compliance costs and other things. But to be honest, most of those companies probably shouldn't be listed if they're that size. And then you have about 850 companies that we'd call SMEs that are in that middle range of sort of 20 to 750 mil market cap. And most of those businesses would also have revenue somewhere between 20 and 200 or 300 million and typically a profitable company. So very similar to the type of companies we focus on our private equity side. You're right, Simon. We were in the paper yesterday, very fortunately, we've had a good run. So I guess morning.
Yeah, I was going to say good run. I think number 1 out of 2,400 equity funds last year, was it? Something like that.
Yeah, so we can only go down from there, but it's, I prefer to be in that position, I guess, than not. But it's been a great team effort, and we've been fortunate to work with some really terrific CEOs and executives and advisors in the listed market space. So the performance has been really good in the fund to date. How does that interact with our private equity fund, where we've been sort of focusing today? Some of those investments have come from Anacacia originally. So, for example, Appen, the business we spoke about before, that's a small investment for the Wattle Fund, but it is an investment for the Wattle Fund. Big River is another company that's come from our private equity portfolio and is now sort of listed. The majority of the companies we're invested in the Wattle Fund actually have come from other sources. We're agnostic when we're looking at things. We're trying to look at businesses, again, those three same criteria. Are they great people, with an aligned management team with an aligned interest? Is it a great opportunity, and is it sort of a fair price? In the listed market, that third one can be a bit more challenging, right? Because prices can change, quite a lot. Every day they obviously change. So that's why there can sometimes be businesses where we think they're great people, it's a great opportunity, but we think the business is a bit overvalued. We might lighten our holding, or we think it's represents good value, so we could increase that sort of holding over time. But what it does mean, particularly, is for those family businesses and private companies that have an aspiration to list one day, we're in quite a unique position whereby our private equity fund can help them take some money off the table, invest, help manage the succession, help that sort of growth. But if there is an aspiration to list down the track, and most of our private equity backed companies, they don't always list, and it's not always appropriate, and some of them want to stay private. That's really important for them, and that's absolutely fine. But for those that have an aspiration to list, the private equity fund is a little bit like training wheels ahead of, with one institution on the register, ahead of actually listing with many institutions on the register. And, our Wattle fund can then be involved with those companies sort of going forward. And so we've been lucky to sort of back some really great businesses in that SME sector that are in that sort of middle space that you can see there.
Thanks, Jeremy. Right, so that's it from a slide deck point of view. So questions. So if anybody wants to drop any questions in, please use the Q&A box on the screen. A question for you, Jeremy, just flowing on from that. So how are you seeing the kind of market valuations out there in the public markets currently?
Look, the valuations are obviously it's very volatile. So if we kind of look at the performance of the listed companies, obviously, the market, the value of shares dropped quite significantly at sort of the height of COVID in Australia a few months ago. The market's come back quite a lot, not quite to the highs where it was, but not far off. Trying to predict what the future holds from a valuation perspective is obviously very difficult. I think what the market's telling us on each of those individual businesses is it's coming to a view as to what it thinks its future cash flows will be, or future sort of profit sort of impact. And the market typically sort of moves ahead of, it's kind of forward looking rather than necessarily historically looking. It was interesting to get that poll at the beginning, right, where 2/3 of the people on this webinar said they think kind of valuation expectations now are probably lower for private businesses than what they were a year ago. And the balance of the other third either said they think it's steady, or they think maybe it's sort of higher. I think the way we kind of look at it is we try to look at each individual business and try to work out, well, what's a solution for the challenge that they're facing? So if it's a succession issue and they're thinking, well, gee, I actually want to put in place some management support. I would like to diversify my wealth. I want to set up a philanthropic fund. I want to make an acquisition. I want some working capital growth. I've got some near-term challenges. Then I guess what we spend quite a lot of time is working out, well, what's that future opportunity and what are the challenges, both at a business level, but also at a personal level for that business owner, and can we help match a solution for them? So, I don't think many people have done more transactions than we have in this space. So, we've done, more than 40 private transactions over the last decade or so with the help of great people like, Simon and Todd and others. And I think that's because we're paying a fair price, but all of them have been exclusive. Like, we've never done an investment where we haven't been exclusive when we're doing the due diligence. And that's because we really want to understand the challenges that the business is facing and craft a solution. And sometimes you can it's not necessarily just as simple as when the public markets of, the price is, X or X plus 20% or X minus 20%. You can use other structures like preference equity that give the new investor a bit more protection on the downside, and you give options that might give more upside to the founders or the management team if things do, better than you expect. And so, we've used a few of those in those sorts of structures in almost all of our investments, just to really kind of make sure that valuation sort of works. But generally speaking, I think most people are more pessimistic about the future now than maybe what they were, sort of 6 months ago. But it depends on the industry. There are some industries that, right now, haven't been touched by what's happening with COVID, and, not many, most have been, but, some positively, most negatively. But, for example, in our wattle fund, some of our largest positions are software providers to government with recurring revenue streams. And, they're not noticing any downturn in their kind of business today. Obviously retailers who, we've got some retailers in our portfolio too, that can be quite tough. There are some suppliers to, some of the distribution in certain sectors like healthcare or pharmacy suppliers, which were very strong, 2 months ago, where there was a bit of hoarding and whatnot that was sort of going on through pharmacies. And then that's kind of brought forward spending. So that's kind of now sort of reduced. So each business is different. And I guess we try to look through things like COVID and the market volatility, both when we're making investments in the wattle fund and the listed side, but similarly on the private side, and say, what's the fair value for this business when we kind of look forward over many years? What do we think the future value of this business is? And based on those future cash flows, and therefore what's a fair structure that aligns interests and enables the founder to do what he or she is really passionate about, and sets the business up for success.
And does that mean, Jeremy, that you expect you might have a few people who come to you now but you might want to wait a few months just to see how things stabilize out the other side, depending on where they're at and how they're going?
Yeah,
or you look at it on an individual basis, obviously, but.
Yeah, look, I think it's never too early to have that conversation. I mean, the best conversations I always think for a business owner, whether or not they're dealing with Anacacia or frankly anybody, if they're thinking about these things, is actually to get on the front foot and talk about it early. Just a conversation doesn't mean you're selling your business or you're selling your client's business or, and, particularly from an advisor perspective, the regret that we often get from advisors is, gee, I didn't even know my client was thinking about selling their business or looking at making an acquisition. And what we hear from the business owners is, gee, I wonder why that lawyer or that tax advisor, they never asked me. Like it's obvious, I'm 68 or I'm 74 or I'm, I might be 46, but of course I'm thinking about ownership change. And, they never actually came with that. So, typically they love it when their advisors sort of come to them and say, look, I'm thinking about this. The worst the advisor gets is, look, thanks for that, but actually I'm staying the course for the next 30 years and seeing if my grandkids want to, run the business. And what we find is, we spend a lot of time reaching out to business owners, and we find, they're really open to having a conversation at the moment. Those that are mature and want feedback, and nobody's going to be silly about selling their business or selling a holding of their business at a time that's not right. But it's never too early to start that conversation, and then really to understand, what's important from an Anacacia perspective, and for us to understand from the business owner's perspective, what does she or he think's important for them? What are their drivers? What are the things they're kind of looking for? And are there things, particularly in the current environment, that actually, maybe there's a great acquisition opportunity, which might actually be a catalyst for them to do, pardon the pun, Joe, sorry using the word catalyst, but the, catalyst for them to do something else in their business now might be actually exactly the right time for them to bring on board sort of a partner. But to your point, these things are never quick. We don't, typically when we first meet somebody to when we make an investment, it often takes many months, sometimes makes many years. And sometimes it can be days or weeks, but that's pretty much the exception.
And people need to get comfortable with, if they're going into a business marriage with anybody, particularly with somebody coming in at an equity level, and you need to build that trust up gradually. You need to talk about things, so it's comforting, I think, to a few people to be able to gradually build that up and discuss things rather than just having to dive in at the deep end when they're not ready, when they're having that discussion at 72, rather than having a gradual discussion from 65 onwards.
So just as a final poll question, if you want to be contacted for a confidential discussion regarding selling down shareholding, bringing in some capital to support growth or M&A opportunities, I'm sure Jeremy and the team be more than happy to have a chat. So if you want to press one of those buttons, we can set that up for you. But on behalf of HLB, to Joe, to Jeremy, the rest of the team, thank you for coming on today and your kind of insights into PE. Much appreciated, and look forward to working on new transactions with you going forward.
Thanks, Simon. I think, there's, as I mentioned sort of before, for you and Todd and the team there, there's no firm we enjoy working with more than you guys, and we really appreciate your efforts and support. And I think it's a very personal thing for business owners to think about bringing in a partner, and for those advisors that are on the call as well, for you to sort of talk to your clients about that. And it is very relationship driven, and it's about having people around you that you sort of trust and you feel like are giving you sort of good support on that sort of journey. So it's great to be involved with this webinar. So thanks for organising it.
No problem at all. All right, take care everybody,
No problem.
and we'll be in touch soon.